Happy Friday, everybody. I know that I stand between you and the Labor Day weekend, but we've got some important stuff to discuss. So a few things I want to update you on. So first of all, when we come back, we're going to do chapter or part two of chapter 4 on Wednesday. There is an activity associated with that. I would like you to you do not need to do any preparation for this activity. I just want to say. I'm still a little bit tentative how it's going to work. Usually when I did this activity in the past, I had like 30 students and it was a little bit easier. We have 16 in this class. One of them is online, so I'm not exactly sure how well it's going to work out, but I'm going to try my best. Okay, we're going to try our best. And then as far as homework and idea goes, so idea is still online. I'm probably going to start deleting the idea assignments this weekend or on Labor Day when I'm laboring. So my plan is that I don't think we're going to do idea assignments for the rest of the semester. And again, it's a double-edged sword because on one hand, I don't think anybody's going to be just kind of like, oh, but I really wanted that extra work, Dr. Barnes. I don't think anybody's going to be excited about that, but it is a data analysis tool that you can put on your resume and say, I've got some exposure to that, and we won't have that exposure. I do think it's a very limited data analysis tool with respect to all the different tools that you'll have access to by the time you graduate from Truman. I'm a little bit sad about it though, but I just don't see a way around it, just given the problems that we've encountered this semester. As I mentioned in class, what we will do is we will have one day that we do work an idea together, and that's going to be in 1420. That will be chapter 8 and 9 discussion. I don't think that there's a good data analysis tool that can replicate the sampling techniques of idea, which is why I want to use that. So if it works, great. If it doesn't work, it's not a big deal, but I will be working through it in that classroom on that date. That's going to be it. For the chapter 1 and 2 homework and the chapter 3 homework, everybody in the class gets a 5, whether you completed the assignment or not, which I realize is not fair for those of you who labored hard and finished the assignment, but that's the only way I can really balance it out. So that's going to be the plan moving forward. My expectations on homework, though, have not changed. In fact, if anything, they're going to be a little bit more stringent. So I ran into this problem last year, early assignments with people not completing the full assignments, and I had that problem this year. And I think I figured out, based on some of the discussions I had, what was going on. And it appears that we've got some people in the class that have got older versions of the book. Now, I do want to say that I don't think that's inherently a problem, but you are responsible for answering the questions that are in chapter 12, and those are not always the same as the one that are earlier editions of the book. So if you're going to use an earlier edition of the book, I'm not going to insist that you go out and buy a new edition of the book. I don't think that's particularly fair, especially if you've got a book. I would strongly recommend that you talk to somebody who does have a current version, which is the 12th edition of the book, and make sure that your homework questions align with those, because there are some small differences, small but very important differences. And that was the case with one of these assignments. I had, I want to say, 3 or 4 people who missed one of the problems, and I think it was largely because of that particular issue. It's because you're using a different edition of the book. So please make sure that you're being very thorough on that. Again, I'm not going to say that you have to go and change it, because most of the content is still the same, but there are some differences. So please check your homework responses. So that's going to be your responsibility. Homework expectations. The first few chapters, I haven't really, I'm not real stringent on making sure everything's done. In fact, I give people a second chance to work through things. That will not always be the case. Once we start getting to closer to the first exam, I will start counting off points if you don't complete the assignments fully. And remember, if you lose points on any homework assignment, you don't get to take the final exam, which is really problematic. So please be thorough, please be detailed. I did have a few things that were just missed here and there. I don't think they were intentional, but they were still missed, okay? So before you submit your homework assignment, please make sure you got every single thing that you need to get done down and submit that. Should be a little bit easier now that I'm not insisting that you do ideal alongside it. So there's that. Today, we're going to start risk assessment. So let me clarify risk assessment. For our purposes, we're going to consider this to be a separate phase of the audit. Technically speaking, this is part of our planning phase. The reason I say that it's separate is because this is kind of the first point where we start critically evaluating information in context of the audit. So when I say phases of the audit, I want you to think planning, and then I want you to think risk assessment to follow right immediately following that. That will not always be clear in some of the vernacular that we'll be using, but I do think that it's good to distinguish them as 2 separate phases. But the question is, what do we mean by risk assessment? And I want to start out with basically a scenario that we're going to use moving forward to kind of illustrate this. So Dr. Caden is going to look at my evaluations at the end of the semester and says, well, did you do your job in your class? And I would say, Dr. Caden, I've been doing this now for 9 years. Of course I did my job in my class. All right. So I'm making this contention. I'm saying, yeah, I taught my students auditing, that when I walk out of there, they are going to know auditing. Now, there's a possibility I could make that contention, and that could be completely, totally false. You know, she could talk to you afterwards, says, well, how did Dr. Bart's auditing class go? Says, I don't think I learned anything. The guy kept putting up memes on the PowerPoint slides. It's like, I mean, he kept teasing other professors and making fun of somebody called Alan. I don't know what the heck was going on. You know, so it's possible I could make the contention that you all know about auditing, which again, that's my objective. That's my objective in this class, teach you all auditing, and you don't. Okay, I could say that you do and you don't. All right, so that is in a nutshell kind of the idea when we talk about audit risk, is making a contention that something has happened when in fact something has not happened, or vice versa. So audit risk, we've talked about it already. It's the risk that an auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. So an auditor goes in, does the audit, and they say, you know what? I performed my audit, the financial statements look good. And then the company Enron goes bankrupt, okay? The client named Enron goes bankrupt. Yeah, so that would be an example of an audit risk where the problems exist in the financial statements. We talked a little bit about this when we started out our lectures. Our very first lecture, I said, science, there's type 1 and type 2 opinions. All right. Type 1 opinion is saying that there's a problem when in fact everything is fine. Type 2 opinion is when saying that everything is fine when in fact there's a problem. Audit risk is a type 2 error. Okay. It's a type 2 error. So let's see if this works. Okay. So unqualified opinion and materially misstated financial statements. Nope. The GIF doesn't work. So this is not just a picture of a planet. It's actually a picture of the world exploding. Okay. And I check this every single time before I do the presentation. And on my computer, it looks good. And then I come to the classroom and it's like, it's just a picture of planet Earth. Okay. So I want to take a moment. I want you all to think about what it would look like if this was a cool animated GIF where the world was exploding. Okay. Yeah. I see people doing that in hands. All right. Thank you very much. Thank you for living in this fantasy with me. So yeah, it's not obviously not that extreme, but that's kind of the scenario we're talking about with respect to audit risk. So wait a minute, hold on. See this. Nope, didn't work. Okay, it froze. I thought maybe I had to click a little bit further, but oh well. So audit risk is based on these assertions that we've talked about. Now remember, we get some examples of the assertions, and we're going to go in depth on those starting in week 5. I think maybe week 4. Sorry, week 4 we're going to go in depth on those. But assertions are expressed or implied representations made by management regarding the recognition, measurement, presentation, and disclosure of information in the financial statements. So anything that's in the financial statements is based on an assertion that management has made. And we know our responsibility as auditors is to evaluate those assertions. We've used a simple example. Let's expand that example out a little bit. All right. So financial statements have contained an account balance of $30 million for inventory. Management is representing that the inventory exists and that it is properly valued. So you can imagine a picture of a 10K in your mind, or a trial balance, whatever it may be, and you can see that inventory line, it says $30 million. By putting that on the financial statements, management is effectively saying, look, we have inventory out there, physical inventory, okay? We promise it exists, okay? It's in a warehouse or mini warehouses or whatever. That it exists, and that the basis that we use for valuing this inventory is sound. Our responsibility is to say, let's go ahead and look at this inventory. Let's look at this inventory account, make sure it does in fact exist, and that the valuation basis is reasonable. We already talked about the existence part. How can we go do that? We can go look at the inventory. We're concerned about whether the inventory actually exists. We can go look at it. It says, oh, inventory. How about that? Okay. Valuation is very similar. Remember back in your intermediate classes when you said, oh, right, there's many different bases of value of inventory. There's FIFO, LIFO, average cost. As long as you know what the basis is, you can look at the past calculations and you can say, all right, here's what I calculated. Does this match what the client has? It sure does. Looks like the valuation is correct. In simple terms, our job is just basically to look at that and to determine whether or not that's the case, whether or not these assertions are sound. Now, in order to go drill down a little bit further about how we're going to approach this, we need to start talking about the components of the audit risk model. At the assertion level, so when we're evaluating assertions as part of the financial statement audit risk consists of 2 primary components. All right. And we're gonna put these in the function of an equation. Okay, we're gonna put these into a form of equation. All right. So the first component is going to be the risk that the relevant assertions related to the financial statements contain misstatements that could be material to the financial statements. All right. This is basically comprised of two items called inherent risk and control risk. The second component, and we're going to talk more about these in detail here in just a second. The second component is the risk the auditor will not detect some such misstatements. So the first part is that misstatements exist in the financial statements. The second part is we as auditors fail to detect those misstatements. Those are components of audit risk. Now let's break this down a little bit more. Let's break this down a little bit more detail. All right, so I want to talk about these components, and I want to talk about kind of, again, using our example from context. So remember, my example was that in this course, I could contend that you all know auditing, when in fact, when you leave the class, you know nothing. Like assertions, I don't remember, compactness, exuberance, those sounds like assertions to me. Like you could be telling Dr. Caden this, she'd be able to saying, I don't know what it is, but that doesn't sound right, okay? So what are some reasons why? Well, there's a few possibilities, all right? Logical possibility is there's a problem with the course itself. The course itself contains issues, all right? Not necessarily the structure of the course, just the nature of the course, all right? First of all, there's a lot of information about auditing, a lot of information out there. We're going to talk about a ton during this course. We're probably only going to cover 10% of the content that's out there. It's available, all right? Secondly, it's constantly changing. The nature, it's not quite as bad as tax, which changes every year, but it changes pretty consistently, especially really, really important stuff, early theory and philosophy. Probably one of the biggest parts of this is boring, okay? Let's be honest, okay? Nobody comes into exuberance in class. Yes, I get to learn about controls today, yeah! All right, if you are like that, you're doing a good job at hiding it, first of all, okay? But, Alan Davis, who I used to talk about, that Alan guy that I used to make to us, he was a tax professor, and he says, yeah, the problem is that auditing is really boring. I said, yes, auditing is very boring. It takes an exceptional structure not to make it that way, okay? And I made him silent on that statement, which it was very rare for him, okay? So yeah, there are some risks associated with this course, okay? We're actually trying to relate that to this idea of inherent risk. Now, inherent risk, the long definition is the susceptibility of an assertion and a counter disclosure to a misstatement due to error or fraud that could be material, either individually or when aggregated with other misstatements, before consideration of any related controls. All right. That's a lot, and I don't want you to memorize that. Instead, what I'd like you to think about is I'd like you to think about this: the fundamental risks related to an entity's operations. All right. The fundamental risks related to an entity's operations. By going into business, you are subjecting yourself to some set of risks just by the fact that you're in business in that particular area. By teaching an audit class, I have certain risk. The stuff is challenging, it's boring, it's constantly changing, all right? I know that, and so I have to design my class to address those particular risks. Now, what are some concerns we have with respect to the environment, with respect to inherent risk? What are some inherent risks that we're going to concern ourselves with real world auditing? Well, one of the big ones is that many of the companies that we'll be auditing have a large volume of transactions. It's not just one or two transactions that we can test. There are thousands, if not millions, of transactions taking place. There are complex tasks and calculations. Remember when we were talking about materiality and I talked about intangible assets, and I said, who here feels comfortable with intangible assets? And nobody raised their hand because nobody on the planet is comfortable with intangible assets. All right. There's the use of estimates. Accrual-based accounting, one of the things that we know from accrual-based accounting is sometimes we have to make judgment calls. Remember when you were talking, we learned about, or you learned about overhead back in 221, okay? Whether you're with Dr. Otero or Dr. Shaniwa or whoever was teaching 221, and it says, okay, we've got to allocate overhead. And you're just like, you're just making things deliberately confusing, aren't you? It says, no, that's what accountants do, is they try to make estimates for how much value should be. And that's commonplace in accounting, commonplace in those estimates. There's the risk of technological obsolescence, okay? One of my favorite things to talk about is this thing right here, which I hate, okay? It's like, that's a really nice iPhone, Dr. Barnes. Why do you hate it? It's because my thumbs are big. So when I try to type out a text message, it doesn't look anything like how I intended. What I'd like to have is a BlackBerry, but can I use a BlackBerry anymore? No, they're obsolete, okay? So that's a problem that we're concerned about. Working capital concerns, companies that are failing, companies that do not have sufficient cash flows, they may actually commit fraud. So we're concerned about that scenario. And then increased business risk just in general, which we'll talk about business risk at a very high level here shortly. But we're starting to see changes in the business environment and companies that are subject to these concerns. One thing that you probably have heard about is this thing called cybersecurity, all right? That's a risk for any large organization that's going to be technologically connected, is that they're going to be under threat from attackers. So a lot of things to consider when we talk about inherent risks. That's not even a comprehensive list. Those are just some that I came up with, and you're just like, that's too much, Dr. Barnes. Go back. Go to like 2. Okay. It's like, no, I'm not gonna shortcut you. You guys are paying me good money, so I'm gonna give you as long a list as I possibly dare. But at its nature, it's anything that's going to affect an organization just on the basis of it. But we know because we all took AIS together, we all were in AIS together, that there is a way to address risks. We have a magic term at our disposal, a magical item at our disposal that we can use to respond to risks. What are those called? The magical thing that we use as a response to risk. Controls. Yes, controls are responses to risks. Okay. If controls are good, then we can eliminate those risks, which is great. But is it possible that the controls themselves could be faulty? Yes, certainly. Okay, so let's think about this course. I know that there are risks associated with this course. I know that it's boring. I know that it's complex. I know there's a lot of material. So I'm going to actually impose some controls in this course to try to make sure that everything works. All right. So how can those controls fail? Well, one control that I have is that I'm trying to teach you the material. I'm trying to convey the material to you through certain mechanisms. What if I failed to do that? What if I just stood up here talking and said, you guys, I just don't like grading homework, you know, I don't like grading exams, so I'm not going to do that in this class. You'd be like, yes. Okay. And at the end of the class, end of the semester, be kind of like, I don't remember anything that you talked about again. It's like, again, compactness, exuberance, those are the assertions. Yeah. If I fail to give exams or assignments, all right. Another risk could be that I do give exams or assignments, but what if the exams and assignments I give do not cover the material that's relevant? All right. So I teach you in class, I say, okay, I'm going to teach you everything you know about auditing. And then, you know, say you need to know the material about assertions. You need to know about audit risk. You need about how documentation and how to test. And then I give you an exam and say, what are my 3 favorite memes from the course? And you just have to fill that out. That's funny. It's hilarious. It might be kind of neat to do, but really doesn't teach you auditing, does it? Okay. So it could be that I don't have necessary controls in place, or the controls I do have in place do not address the particular issues that I'm concerned about. All right. Let's talk about that with respect to the audit risk model. Let's talk about control risk. The risk of a misstatement could occur in an assertion with an account disclosure about an account disclosure that could be material, either individual or aggregated with other misstatement, will not be prevented or detected and corrected on a timely basis by the entity's internal control. So basically, the controls are either not there or they're not functioning properly. So in other words, any risks that are still present after an entity takes action to address its inherent risks. So we know risks are present. We identify those risks as part of our risk assessment, and then we go in and say, let's put controls in place. If the controls work, there are no remaining risks. If the controls don't work, then these are the risks that we're concerned with. These are risks that still are present, due to control failure. Now, there are a few ways to think about this, okay? There are a few ways to think about this. First of all, remember from 367 when we talked about controls can either be preventative or detective in nature. And you will notice that definition actually embodies that. It says that the errors, the misstatements will not be prevented or detected and corrected in a timely manner. So that's pretty consistent with what we already know. But let's think about how this will work in the real world, all right? The first risk is that controls have not been properly implemented. So my example is that I don't give exams or homework in the class. All right. That would be a failure to completely implement controls in an environment. The way that we refer to that in auditing perspective would be a deficiency in design. The controls just aren't there. The other possibility is that the implement controls are there, but they aren't effective. So I give you exams, I give you homework, but instead of asking you questions that are relevant to what we talked about in class, I talk about my favorite video games, all right, which I will probably talk about in the class. Or I talk about my fondness of cheeseburgers, which I had a cheeseburger last night, so I'm in a good mood, all right? So I talk about all these things that are completely and totally irrelevant, and or test you on these things that are completely and totally irrelevant. That would be the implemented controls themselves being ineffective. That would be a deficiency in operation, all right? So either controls are not designed or not present, or the controls are there, but they just don't work. Okay, they're just not working properly. Deficiency in design, deficiency in operation. So these are some things we have to think about with respect to audit risk. We have to consider both of these jointly because these are really, really important. So the audit risk model basically says that the inherent levels of inherent risk and functions are levels of inherent risk and control risk are functions of the entity and its environment. The auditor has little or no control over these risks. And this is an important takeaway, because when we start talking about the audit risk model function, it's important to note these are basically constants. We can evaluate and assess these in advance, but we cannot change these. This is a function of what the entity does. What if we decide to take an audit of a business that's in a highly competitive industry, we can't change the fact that they've got a high inherent risk. We don't have any mechanisms to track that down. That's a function of them, not of our work. If we test controls and we find the controls themselves to be lacking, we can't change the risks associated with those controls. We can't say, oh, well, we're going to do more work and that way we can make their controls better. That's not the way it works. The client management is responsible for implementing and designing controls, not us. We cannot change the values that are set here. So auditing standards refer to the combination of inherent risk and control risk as the risk of material misstatement. Jointly considered together, these are the risks of material misstatement that are present in the audit. Now, let's go ahead and let's talk about the third component, the other component of the audit risk model. This is this thing called detection risk, okay? So I'm going to kind of use my analogy again. I know that if I don't teach the class properly, that you all will not learn auditing. So I've got mechanisms in place. I've got my controls in class to make sure everything's working properly, everything's working correctly. So then Dr. Caden is going to come in and she's going to ask me at the end of the semester, am I doing my job effectively? All right, she's doing my job effectively. And basically, she's going to evaluate based on your responses, based on the grades that are in the class, based on your performance in other classes, based on what your evaluations say, am I doing my job effectively? So there's going to be some effective interpretation. Is it possible I could fool her and just say, yeah, I'm doing my job properly? She says, yeah, he is doing his job properly. Good on Dr. Barnes. You know, I've been fooling her for like almost 9 years or almost 10 years now, so it's good work. But you know, is it possible to do it? Yes, that's absolutely possible. It's possible that I can make her think that I'm doing a good job when in fact I have no idea what's going on. I'm just really good at creating memes and putting them into slides. Okay, I'm really good at using analogies with food, so that makes people think that I sound like I know what I'm talking about. That's the idea of detection risk. So detection risk is the risk that procedures performed the auditor to reduce audit risk to acceptably low level will not detect a misstatement that exists and could be material either individually with aggregate with other misstatements. In other words, any remaining risk after planned audit procedures. So the auditor comes in and says, this company has high risks because of the area they operate. It looks like they put controls in place to address that, but there's still some risk remaining. So in order to do my job effectively, I have to know what risk remains, and I've got to design my testing procedures appropriately, because some of these controls may be effective, some of them may not. And so any risk that remains is my responsibility. That's the idea of detection risk, is that I have to do my job. I have to do enough testing. I have to get enough assurance to make sure that my ultimate conclusion is correct. All right. So detection risk is determined by the effectiveness of audit procedures and how well the procedures are applied by the auditor. Now, it's important to note, remember I said for inherent risk and detection or inherent risk and control risk that we can't control that as auditors. Those are functions of the entity and their environment. We can control detection risk. Once we've evaluated how much work we have to do, that is our judgment to say, all right, this is the work that we need to do. This is the quality of work we need to implement. And this is actually a little bit confusing, but we'll get to that here in just a second. All right, to move forward, I want to talk a little bit about this concept of engagement risk. This is outside the audit risk model, but it's still relevant. Okay, so in addition to audit risk, the auditor is subjected to something called engagement risk, and this is, as it sounds, the risk associated with any assurance engagement. The risk of the auditor exposed to financial loss or damage or professional reputation from litigation, adverse publicity, or events arising in connection with audited financial statements cannot be directly controlled by the auditor, but some control can be exercised through the careful acceptance and continuance of clients. Remember last chapter, we said, are we going to continue to audit this client? Are we continue to audit EWC? In many scenarios, we'll say, yes, this is a good client, but we do need to evaluate very, very critically every single time we make a decision, because it's not always going to be an automatic yes. An interesting example happened a few years ago. There's a company called Grant Thornton. They're a large regional firm, and they decided to stop being the auditors for a company called MindGeek, which I had never heard of this company before, and I still don't know really much about this company. Although from the article that I read, this company called MindGeek. I'm not going to say the name, but you can use your imagination. They operate a website which is a hub for adult content. Okay. Now, this is an example of the engagement risk that we're talking about before. Grant Thornton decided that this is a reputation concern being associated with this particular client. And they said, we do not want to be the auditors of companies that produce such content. So that was an example of that. And I know that's not a very pleasant thing to be talking about in a classroom, but it's a very, very accurate example of this particular concept. Okay. All right, so let's go ahead and move on to the audit risk model. So the audit risk model can be specified as audit risk is a function of risk and material misstatement and detection risk. Or if we expand it out, audit risk is inherent risk, control risk, and detection risk. Now, this model expresses the general relationship to audit risk and the auditor's assessment of risk and material misstatement and the risk of audit procedures would fail to detect a material misstatement and a relevant assertion. So what does this mean? Well, there's a first few things that we need to take away from this. First of all, when we evaluate this, we already know that risk and material misstatement, or these two components right here, these are not within our control. These are basically something that is established by the client's operations. So the things that we can control as auditors are detection risk and audit risk. Now, I want to make clear on a few things here, a few things that are relevant here. First of all, when we talk about audit risk, generally speaking, audit risk is considered to be a constant. All right, think about this as a mathematical variable. A constant is like an actual number that never changes. All right, it's not like the letter X, which can be different values depending on other values. Audit risk is considered to be a constant. We either set that at low or in extreme situations, very low, but it's always going to be a minimal amount. Setting audit risk at high doesn't really make any sense because that would defeat the purpose of an audit in the first place. All right, so we're going to set audit risk at low. That means that the one thing that we can control is we actually address detection risk. We adjust that with respect to what these other values are assessed at. If we set this at low, if we set inherent risk at high, if we set control risk at high, that's going to depict what our determination of detection risk is. Now we're going to talk about that at length here in just a second, because this is a really important concept to understand. But one thing I do want to say is, generally speaking, we can actually say that inherent risk and control risk are indeterminate of one another. And what that means is that the lowest value of either one is going to set risk and material misstatement. Okay. So whatever we set inherent risk and control risk, whatever the lowest value is, that will be what we set risk and material misstatement is. And it's not immediately obvious why that's the case. So I put together this sweet visual that I put together in MS Paint, and you guys are going to be super impressed at my MS Paint skills. Okay. So here we have Club RMM. Okay. Club RMM, which Club Risk and Material Misstatement. All right. So we have got two doormen at Club RMM. We've got Irving, okay, IRVING, all right, and we've got Craig, CRAIG, all right. So you can see the two doormen, IR and CR, and then this is the club, which you can kind of see the clubs here. There's a table over here, and then there's the DJ stand, which DJ double I, which is Dr. Ison's side hustle, okay, one of his many side hustles. So Craig and Irving are both responsible for letting people in the club. All right. And if they let in a consistent amount, both the two of them at the same time or same amount, that's how many people enter the club. So like say Irving lets in 10 people an hour, Craig lets in 10 people an hour, because this is a really exclusive club. You can't let too many people in. So 10 people come in here, then 10 people come from the waiting room. We can say the people get in the club is 10. Okay. Because they both let in the same amount. What if Craig is in a bad mood and says, you know what, I'm not letting I'm not letting one person in per hour. It doesn't really matter how many people Irving lets in. They're all just going to be stuck in the waiting room before you get to the club, right? Okay. So Craig is the bottleneck here. So whatever he sets the lowest level at, that's the number that's getting into the club. But Craig suddenly gets into a good mood, says, you know what, I'm being kind of a jerk. I'm going to start letting people in. But Irving now is miffed off at Craig. And so, you know what, I'm not letting anybody in either. So I'm only going to let one person in. So Craig is now willing to let 50 people in at a time, but Irving's only going to let one in. There's still only going to be one person getting into the club. Okay. So that's a way to think about that when we talk about the restriction on RMM, is that basically whatever we set the lowest amount at, that is what our RMM is set at. Practically speaking, we can almost even rely on just control risk, because most of our examples that we'll talk about in this course, inherent risk will be set at high. We're going to be dealing with large companies with diverse operations. It doesn't make a lot of sense to say, well, inherent risk is medium. It might be true for smaller companies that have that are not publicly traded, but for most of our examples, we're probably going to be saying inherent risk is high, meaning that we're going to focus on this control risk. So that's something to keep in mind as we move forward, as we start thinking about RMM. we're probably going to default to this being high. So basically 2 of our numbers will effectively be constants. This will be low, this will be high, and we're going to try to make a determination of what control risk is so we can determine detection risk. Okay, so we can solve this equation like we can a mathematical equation, meaning that detection risk is going to be a function of audit risk and risk of material misstatement. Now, this brings up some interesting points, okay? We know that audit risk, we've already determined that that's going to be a constant. So even though there's a direct relationship between detection risk and audit risk, that's irrelevant because audit risk never changes. Again, it's pretty much just low. That's all there is. So the only thing that really affects our determination of detection risk is what risk of material misstatement is. And mathematically, what do we know about numbers that one's in the numerator and one's in the denominator? Are they directly related or inversely related? So if I change risk of material misstatement, if I say I change this numerically, so I make this larger, what's going to happen to detection risk? Smaller. And if I make this smaller, it's going to be larger. So what we're effectively determining is risk of material misstatement and detection risk have an inverse relationship to one another. And that will make sense as we start talking about it here in just a second. To be like, oh, that's completely and totally intuitive. Some of it's intuitive, some of it's not intuitive, but we'll talk about why in just a second. So due to the subjectivity involved in judging the auditor's risk and model components, many public accounting firms find it more appropriate to use qualitative terms rather than percentages in the model. So you will notice that I've not said numbers. Could you put this in terms of numbers? Absolutely. You'd have to use percentages because the numbers don't work out if you use whole numbers, but it's absolutely possible to do this. That being said, most companies, most firms will actually express this in terms of qualitative values. So usually low, moderate, high. So let's go ahead and do that. Let's see if we can actually figure out how this works, okay? So we've got our clients here with audit risks. You can kind of see these are constant. We got low or very low. I don't want you to read too much into the low or very low. These are not variable amounts. We're just going to say that this is low and move on with our lives. So risk of material misstatement is going to be moderate, high, low, moderate. So let's go ahead and determine what detection risk is based on that. So if audit risk is low, risk of material misstatement is moderate, what is detection risk over here? So it's inversely related to risk of material misstatement. We're going to ignore audit risk. There is a direct relationship. We're going to ignore that. What's the inverse of moderate? If we say we got 3 measures, low, moderate, high, what's the inverse of that? Moderate? They're both moderate, okay? So detection risk here is moderate, all right? Audit risk is very low. Risk of material misstatement is high. That means our detection risk is going to be low. Yeah, detection risk is going to be low. Audit risk is low. Risk of material misstatement is low. That means our detection risk is going to be high. Good. And then very low audit risk, moderate here. That's effectively not any different than audit risk being low down here. These 1 and 4 are effectively the same. This would be moderate as well. All right. So it's important to know that. Now, this leads to some interesting questions. This leads to some interesting issues because it's not intuitive. Because I basically said the risk of material misstatement is low here, and then we said detection risk is high. When we hear the word risk, do we generally think that risk being high is a good thing? No, we're accountants. We're just kind of like, no risk whatsoever. No more risk. Okay. So the detection risk issue becomes problematic because the interpretation of detection risk is problematic. So as we know, and we're going to talk about that here in just a second. So as we know, detection risk represents the level of risk the auditor is really willing to tolerate related to its audit procedures. So we talked about detection risk and say, this is something an auditor sets. It's important to think about this. And by the way, the reason I mentioned this and the reason I focus on this so much is this confused the heck out of me when I first took auditing because my first auditing professor didn't explain this very well. So I'm going to really try to drill this home. When we say detection risk, we are talking about a tolerance for risk, okay? We're not talking about the actual risk. We're talking about how much risk the auditor can tolerate. If the auditor can tolerate high risk, that's a good thing.
Yeah.
Apparently only some auditors can only tolerate low risk. Okay, yeah. You want to change chairs out there so you don't hurt yourself?
These chairs are probably older than us, to be honest.
That was a way to break the suspense there, Jared. Yeah, it's impressive. Are you okay?
Yeah.
Okay, cool.
I was thinking.
I should probably ask that first. Yeah, so when we talk about detection risk, if we're having high detection risk, that's a good thing. If we can tolerate more risk, that means that we can do less work. What if I say detection risk is low? I'm saying the auditor can tolerate a very low amount of risk. In that case, that means the auditor has to do more work, which is effectively what's being talked about here. If the detection risk is high, our net is low. The net is nature, extent, and timing of work. That means that we have to do less work than we would otherwise expect to. If our detection risk is low, we can only tolerate a very low amount of risk, meaning that net is high. Means the nature, extent, and timing of our work has to be very substantial. We have to do a lot more work and a lot more rigid detail in that work. Now let's just think about this logically speaking. So I've said that detection risk is inverse to risk and material misstatement. And now we know that detection risk is inverse to the amount of work that we have to do. So if I'm saying risk and material misstatement is high, I'm saying that relevant to its inherent operations and the controls that are in place, our client has a lot of risks associated with this. Okay, saying the chances of a risk in their financial statements is very high. If you were an auditor in that situation, would you expect to do more work or less work? More work, okay? So that's consistent with the way we're talking about, because we say over here, risk and material misstatement is high, detection risk is then low, meaning that the work that we have to do is pretty substantial. What if I say, you know what, this client has got really high inherent risk, but they've got fantastic controls. They put really good controls in place. So control risk is low. That means their risk and material misstatement is low. If there was a low chance of risk, how much work would you expect to have to do at an auditor or client like that? Probably not very much. It'd be like, the client's doing a great job. My job is going to be easy. So I'd say risk and material misstatement is low. That's what you read over here. That means detection risk is high. And the net work that we have to do is low. So even though we express this mathematically, intuitively, it makes sense. Intuitively, the relationship makes a lot of sense. All right. To properly assess the risk and material misstatement and engagement risk, auditor needs to understand management's objectives and business strategies and the related business risks that may result in material misstatement. Now, business risk is a broader concept than the risk and material misstatement. However, most business risks have the potential to affect financial statements either immediately or in the long run. The reason I bring this up is oftentimes the way that we are going to frame inherent risk in this course is going to be the identification of business risks that are relevant to our client. You're already familiar with these to a certain extent because you've done financial analyses in other courses. So if I were to say, what would be a threat to earthware clothiers? And you'd say, well, they have a lot of competitors in their industry. So we'd say the industry is volatile and subject to high competition. That's a business risk, but from our perspective as auditors, that's also an inherent risk. That's a risk associated with their operations. Anytime an inherent risk is present, an auditor needs to be on the spot saying, all right, have you addressed this risk properly through use of controls? And controls should be used in every scenario that's possible, because if there's an inherent risk present, then there's a chance for a misstatement associated with that risk. Ultimately, what we're trying to conclude is, what is the ultimate risk and material misstatement with the client? How do we approach that as auditors? So we're going to evaluate this pretty thoroughly, pretty diligently moving forward. And we're going to have a lot of different exercises to expand upon this. The easy thing that I think that you need to focus on right now is to focus on this particular model right here. And like I said before, for the most part, audit risk is going to be a constant that's going to be set at low. Inherent risk is going to be mostly a constant for our purposes. That's going to be set at high. So we're going to be very, very scrutinizing this value here and this value right here. And this is going to actually be our determination of what this is. All right. So as far as we move forward, we're going to talk about a little bit about what audit risk assessment process entails. Now, this is important because this is the first time that we're going to actually talk about evidence in context. Now, we're not going to do any assertion level testing at this point in the audit, but we are going to gather some evidence to actually try to test certain positions or certain aspects of the client. We don't actually start assertion testing until we get test of controls. And that's going to be, again, in a few weeks when we get to chapter 5. But we do need to actually be able to make some assessments so we can do planning for the audit moving forward, so we can know what our approach is for testing controls. So how do we go about that? Well, I'm going to give you a list of 4 right here. And I want you to make notes on this list, because when we get to our procedures in chapter 5, we're going to reconvene and talk about these again. The reason this is important is, according to standards by the PCOB and the ASB, Auditing Standards Board, There are only certain types of procedures an auditor will conduct during certain phases of the audit. So it's important to know what type of procedures those are. So we're doing preliminary risk assessment procedures. The first thing that we would obviously do is we would try to say, can we look at the client's records, at least some of those that are available at this point in the audit? And the answer is yes. We're going to perform an inspection of records and documents related to the business operations of the client. Another thing we might ask is we might say, can we observe some of the processes and the operations that the client has in place that are relevant to this phase of the audit? Answer is yes, we can observe personnel and processes. Another one we might say is, can we talk to people? Can we go and talk to management? Can we talk to individuals who are responsible for certain operations and certain aspects of their financial statement procedures? The answer is yes, we can inquire people both within and outside the entity. Now, there's a couple of points that I want to make here. First of all, relates to inquiry. Generally speaking, we don't perform inquiry tasks to people outside of the entity. We have another type of procedure that we usually use that's more official for that. So talking to people outside of the entity does happen, just not very frequently. Usually it's restricted to people within the entity. Second, and this is by far the most important of these 2 points, these 3 items right here, I want you to take special note of: inspection of records and documents, observation, and inquiry. These are 3 types of evidence that you can use in any phase of the audit, okay? So we're going to talk about 3 distinct phases of the audit. We're going to talk about risk assessment, we're going to talk about test of controls, and we're going to talk about substantive procedures. And at some point in the semester, probably multiple points in the semester, I'm going to ask you the following question: what types of evidence can we collect during these phases of the audit? It doesn't really matter what phase of the audit you're in, you can answer 3 of these right off the top of your head: inspection of records and documents, observation, inquiry. These are the most versatile forms of evidence that we can gather. So that means that we can use them during any points during the audit. So these are the 3 that will always come up. I don't want to call them the big 3 because I've already used that term for our assertions, but these 3 often come up, or always come up when we talk about testing. It doesn't matter what phase of the audit we're in. So these are like 3 extra bonus points if I ask you a question on the exam about what types of procedures you can perform. These are 3 you should automatically get. I will say on previous exams, I've said, we already know that we can collect these 3 types of evidence during the audit. What other types of evidence? So I'm not quite that simple as far as my questions go, but it's good to have this information anyway. The other one that we can collect is called preliminary analytical procedures. We're going to come back to this because we've got a whole half a day devoted to discussing analytical procedures. And basically what that is just an estimate or developing a model or an expectation based on financial information provided by the client. Depending on when we conduct analytical procedures, we actually gain certain types of information. This is a planning analytical procedure. This is looking at very high level information and saying, based on what I observe, what are some areas that I should focus on? This is not all that different than an analytical procedure that or the type of analysis that you did for a financial analysis for your finance course or your accounting courses. You can take financial information and you can say, this is interesting because if you look at their relationship between current assets and current liabilities, it looks like their liquidity is suspect. This would be an area that I would focus on if I was in the company. Guess what? We can do the same thing as auditors. We can say, look, their cash balance is steadily declining over time. I'd want to investigate why cash balances are problematic. So this is the type of work that we would do for this particular procedure. All right. Evaluating the entity's risk assessment process. Now, this is going to be something that we'll talk about in detail because we're going to talk about the COSO framework in chapter 6. You guys remember that from 367, the good old COSO framework? That thing that I said is absolutely going to be on the exam, and then I ask it on the exam, and people are kind of like, I didn't know it's going to be on the exam. By the way, it will absolutely be on the exam when we get to chapter 6 as well, okay? So get ready, get ready. I'm going to drill COSO. You're going to have COSO on the brain by the time I'm done, all right? You're going to come back in 30 years and it's going to be a reunion, and I'm going to be in my twilight years if I'm not already dead. And you're going to say, Dr. Barnes, I still remember your lessons on COSO. And I'm going to say, I can't hear you. Yeah. So, all right. The auditor should obtain information on the risk assessment process, whether it's operating effectively. Entity's response to identified risk is adequate. The risk of material statement may be reduced. Well, let's think about what's that saying. All right. What do we call a response to risk again? What are those called? Controls. If the controls are good, then we can reduce the risk of material misstatement. We can reduce that value. We can make that number smaller. However, if the auditor's response to the identified risk is inadequate, the auditor's assessment of risk and material statement may increase. These are just basically saying if controls are good, we can set control risk lower. which means that we can set risk and material misstatement lower. Saying second bullet point, if controls are bad, that means that we have to set control risk at high, means that risk and material misstatement is high. So let's just think about that logically. If control risk is high and risk and material misstatement is high, what does that mean about detection risk? What is detection risk going to be? Low. Do we like low detection risk? No, we hate low detection risk. Low detection risk means more work for the auditor. What if control risk is set at low? That sets risk and material misstatement at low, meaning that detection risk is high. High risk, that sounds bad, right? No, high risk is a good thing. It means we can tolerate a lot of risk, meaning the work that we have to do is significantly less. So this is just a different way of phrasing what we've already talked about. But fitting within the COSO framework, this is basically what we're talking about. We're saying response to risks are controls, and controls are relevant for determination of the work that we have to do. If the entity does not respond adequately to business risk, the auditor will have to develop tests to determine if any misstatements are present and related to account balances or disclosures. What does that mean? They don't develop responses to risk. They don't have good controls. That means we know that risks are present. In order to ensure the financial statements are correct or accurately presented or effectively presented, free from material misstatement, we have to do more work later on. So ask yourself this question. If you had the choice of having a client with good controls or a client with bad controls, which would you rather have? Yeah, well, if assuming that you want to do less work. Now, if you're just kind of like, I really need the money, Dr. Barnes, and I can charge them more if I have to do more work. Yeah, that's a possibility too. That's an option. Okay. But assuming that we're all at Truman and we're kind of like, I don't have a whole lot of time on my hands, so I'm going to try to minimize the amount of work. Better controls are going to be better for less work we have to do. So there are other things that we have to consider with respect to risk and material misstatement, and those are the fact that risks do not take just one simple form, that we can actually identify different types of forms. So what about the risk and material misstatement that we need to go into a little bit more depth? Let's go into an assessment on Wednesday. That's what we're going to be doing next Wednesday. In the meantime, I'm going to bid you adieu and have a wonderful Labor Day break.